Right now, sitting in your bank account, there is money that did not exist 6 months ago. Not printed, not transferred, not earned by anyone. Created. Typed into existence by a bank. Legally. And the strangest part is not that this happens. The strangest part is that almost nobody in the financial system wants you to fully understand how. Here is what most people believe about banks. People deposit money, banks lend that money out, collect interest, pay depositors a small cut. Simple, clean, a middleman holding your cash until someone else needs it. That is not what happens. What actually happens is something far stranger, and once you see it, you cannot unsee it. When a bank issues you a loan, it does not go into a vault and hand you existing money. It opens a ledger, types a number, and credits your account. That number is new money. It did not exist before that moment. The loan itself is what creates the deposit. This is called credit money creation, and it is not a theory. The Bank of England confirmed it in an official paper. Central banks know it. Economics professors know it. It just never quite makes it into the conversation most people are having.
Here is exactly how it works. You walk into a bank, you apply for a $300,000 mortgage. The bank checks your credit, your income, the property value. You qualify. The bank creates two entries at once. On one side, an asset, your mortgage. $300,000 owed to the bank with interest over 30 years. On the other side, a liability, your deposit account, now holding $300,000. Those $300,000 did not come from another customer's savings. They did not come from reserves. They came from the bank's legal authority to create a liability and call it money. You wire that money to the seller. The seller deposits it in their bank. That bank now has a new deposit, which it uses to make new loans, which creates more deposits, which funds more loans. Every major loan works this way. Student loans, car loans, business credit lines. Each one expands the money supply. Each repayment destroys it. When you pay down your mortgage, you are not just transferring money, you are deleting it. Now here is where the math gets uncomfortable. Banks are not creating money without limits. There are capital requirements, regulatory standards, oversight. They cannot lend infinitely. But in March 2020, the United States cut reserve requirements to zero, not reduced, zero. The Federal Reserve eliminated the rule entirely, which means the money supply is not controlled by gold or by government printing or by how much citizens have saved. It is controlled by how willing banks are to lend and how willing people are to borrow. The money supply is, in large part, a function of confidence, of credit appetite, of collective belief. When that confidence collapses, as it did in 2008, money does not just slow down, it disappears. Because loans stop being made. And when loans stop being made, money stops being created. The financial crisis was not just a collapse in confidence. It was money creation grinding to a halt. Here is the part most people find genuinely unsettling. When a bank lends you $300,000 and you repay $450 over 30 years, the bank earns $150,000 in interest. But it created the original $300,000 from nothing. The interest was never created alongside the principal. That $150,000 has to come from real economic activity, real labor, real production, real goods sold in the real world. Which means, structurally, the total debt in credit money system will always grow faster than the money available to repay it. Not because of bad decisions, not because of greed, because of arithmetic. Irving Fisher identified this in the 1930s. Hyman Minsky built his career on it. It is why economies cycle through booms and crises with a rhythm that looks less like bad luck and more like a structural feature of the system itself. So why does none of this dominate the financial conversation? Partly because the mechanics require effort to understand, and most financial media is optimized for speed. But there is also a structural incentive problem. The institutions best positioned to explain this are the same institutions that benefit from it. Central banks publish the papers. They do not run the primetime segments. Commercial banks employ the economists who brief the journalists. The financial system has a quiet interest in being understood as a boring intermediary, rather than an entity with the power to create the money you spend, save, and owe. Global private debt sits above $170 trillion today. That is debt that was, at some point, a number typed into a spreadsheet by a loan officer approving an application. The system holds together because confidence holds, because borrowers repay, because new credit replaces the credit being destroyed. It is a rolling act of collective belief in numbers that were invented and can disappear. When that belief breaks down, the consequences are not abstract. They are foreclosures, job losses, pension shortfalls, government austerity cutting into schools, hospitals, and public infrastructure. There is a question economists discuss in academic papers and closed conferences that almost never reaches public conversation. If banks create money by lending, and central banks create money by buying assets, and governments create money by running deficits, then what exactly is money? Not philosophically, structurally. Because the answer determines what is possible, what is constrained, who holds real power, and who pays when the system corrects. Most people never ask it. Now, you have to decide what to do with the fact that you just did.